All right, let's get going. It's 11 o'clock. So I guess this week is Kotik Kumar from Optimus Alpha, but I've got a little bit of news to have a look at first. Pershing Square Holdings, they've been in town all week and they had an investor meeting yesterday. Gore Street Energy Storage, who've made an announcement earlier on the week. They're keen to sort of distance themselves from the other battery funds, and we obviously talked about them last week. And then we talked about Digital 9 last week, but I just thought I'd just pick up on the most recent news on that too. Pershing Square first. Now, for whatever reason, Morningstar doesn't track the NAV on this, and I did mean to make a chart, and I didn't get around to it this morning, so I'm sorry about that. But there we go. But anyway, I do you can assure you that the discount is about 26%. Market cap 7 billion. It's about halfway up the FTSE 100, so it's really quite a big company, despite the fact that it's been shrinking quite a lot through buybacks. And it's obviously been doing very well. These are the returns to the end of December 2023. And you can see that in NAV and share price terms, it's been beating the S&P, which is the most immediate benchmark, and most other indices for all kind of periods. So really quite decent returns, which is obviously good news, especially in what's been quite a difficult market to beat in the last year. So what drove that? Obviously, it's not going to have a lot of exposure to the kind of Magnificent Seven type stocks, but it did have a holding in Alphabet. That was a new holding during the year, and that was bought early on when people were panicking that maybe Google had been left behind by Microsoft's OpenAI investment. And so they picked it up relatively cheaply, and that's risen the recovery since. But I think it's interesting that it's non-AI type companies that have been doing quite well recently here within the portfolio, especially like things like a restaurant brand for Chipotle there, and also Universal Music, which you think about, it's very similar to business in a lot of ways to Hypnosis, and the disaster that Hypnosis has been and success that Universal Music has had, the two don't seem to ring true for me. That you start to worry about what Hypnosis has been up to. There we go. Anyway, just the big news this week really is all about the changes in the performance fee. So this is slightly complicated, but the base fees are obviously quite expensive. So it's 1.5 on the base fee, and then 16% of all gains above high water mark. And that's was a sort of compromise on the normal kind of 2 and 20 that you used to get for the hedge funds when they used to run a hedge fund business. And so this is obviously a great improvement on that, but it's still not great within our sector. Obviously, if you didn't have to pay that performance fee, then that would look an awful lot better. So one of the things that they put in place at the IPO was that all the performance fees that they earned on other funds, they offset 20% of those against the performance fee on Pershing Square Holdings. So that would reduce the amount that we had to pay out as investors. But that didn't kick in straight away. There was $120 million worth of fees that the manager paid out on the IPO, and they wanted to get those back. So they were getting paid back first, and before the fee with the performance fee was going to get reduced. And that was only down to $36 million. So we hadn't quite finished doing that even since the IPO in 2014. So we haven't had any benefit of this structure yet to Pershing Square shareholders. But one of the things that they're going to do is waive the right to that remaining 36 million. So that falls away straight away. So we sort of should get a sort of the offset starts to kick in straight away, which is good. And then they're also launching some other vehicles that will generate fees, and they will also offset the Pershing Square performance fee. So the first of these, what they did was they explored quite a long time trying to relist Pershing Square in New York, thinking that if they could do that, they would attract an awful lot of US investors, and that would drive the discount down. It doesn't work for various regulatory reasons, but also from a tax point of view, because if US closed-end funds pay gains on the disposals that they make, pay tax on the gains that they make in disposals, and obviously investment companies here don't. So that would have changed the whole tax status of the vehicle. It would have been great. But nevertheless, in the process of doing all this, they did realise there is quite a lot of demand for a Pershing Square Holdings type vehicle from US investors. But if they were going to set up a US closed-end fund, do the same sort of thing, it can't have a performance fee. So they said, well, what we'll do is we will charge a 2% base fee and no performance fee on this, Pershing Square USA. It's going to have a very similar portfolio to Pershing Square Holdings, but it's going to have more holdings. It's got the same kind of investment ethos, so sort of big cap, cash generative, quality companies. It's also going to have these hedges on the going on in the background. These are quite small bets within Pershing Square that are designed to not lose you very much money if they go wrong and make you a lot of money if they go right. So it's asymmetric bets, and then say about 12 to 24 positions. But they think they can get an IPO somewhere between 10 and $20 billion, which is incredible if they can actually pull that off, but we'll have to wait and see. They have actually filed something with the SEC, so this is about to kick off now. So the base fees on PS USA are offset, which obviously cool. So a $10 billion fund would take about $40 million off the PSH fee. So they'd say 20% of the base fee. And they're also going to launch a dedicated private vehicle, probably a hedge fund type thing, and focused on those asymmetric derivatives trades. And all the performance fees on that, 20% of those will be offset against the fee as well. So I think you can imagine that you get to a position where Pershing Square Holdings doesn't have to pay for performance fees at all. And other bits of good news is that Bill Ackman says he's not going to sell his Pershing Square stake in favour of investing in the new funds. He will put money into the new funds, but from his own money, not by selling down the existing thing. And he basically said he's going to want to hold it till he dies. And then they're also going to free up some liquidity within Pershing Square Holdings by selling part of the Pershing Square Holdings stake in Universal Music to Pershing Square USA. That's a good idea because Universal Music is a big chunk of the portfolio. It's quite hard to find exactly what because they don't publish the weightings in the portfolio over. But we'll wait and see how that works out. But I think it's going to be quite a big sizable cash injection. Though you might remember there's a long saga with the Pershing Square Tontine Holdings, which was their version of a special purpose acquisition company, a SPAC. They've come up with a different structure that they think works better than that, this Spark Holdings thing. And it's actively looking for an acquisition target. This is a way of taking a private company or a division of a public company and making it into a listed company, by basically reversing that into the Spark Holdings structure. If that happens, then that's going to be a major new investment for Pershing Square Holdings. And because of that, they're looking for something that fits the normal kind of criteria for Pershing Square. They're still going into buybacks, so they've got plenty of cash to keep funding those. They spent $200 million on them in 2023, and they bought back $1.3 billion in total since they started doing this. So they've got quite a lot of cash. I think it's going to be interesting just to see what happens in the next few months because at the moment it's sort of sitting there poised ready to do something more exciting. They've got about 7 holdings left because they've just sold Lowe's, which is the kind of DIY store thing in the States. We might sell this Universal Music stake. They've got quite a lot of cash already. It's kind of watch this space, I think. Anyway, Gore Street. It's had the same kind of set-off as you've seen in the introductory funds. It rallied when it managed to it looked like it convinced people that it's not going to be affected, and then it fell back again. So they felt they needed to make some kind of statement and just point out the facts here. It's not a massive company, 350 million, but it's reasonable size, and it's now trading at a discount about 36.5. So the trading statement just wanted to reiterate that they will pay a dividend, and it's targeting 7% of NAV this year. So on that basis, it currently yields 10.6, and they're saying we can pay that, we will pay that, and the dividend was covered in Q3 23. and the implication is it's going to be covered or near covered by earnings as we go forward. But that's not an explicit statement, but they're definitely going to stick to the dividend anyway. Now that's obviously the big differentiator between it and the other two battery funds that have had to pass their dividends. And the reason it's able to do that is because it's earning more on average on its batteries than the other two are, and that's because of its geographic diversification. They've also not got too stretched a balance sheet, so they've got some cash and they've got an undrawn revolving credit facility, RCF, and that's enough to build out the things that they are building out at the moment and meet all the kind of cash obligations of the portfolio. So tick, 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 really, it does look like it's in a reasonable shape. This is where the revenue comes from. This is at the end of September 23, so it's already moved on a little bit from here. But you can see that this is a breakdown of revenue, not of investments, that most of the revenue is coming from Northern Ireland. There's a big chunk coming from the States. ERCOT is the Texan grid. A little bit in Germany, where they've got one operational battery, but they might want to do more down the line, and only 19% from the UK. It's the fact that that's a relatively low percentage that means that they're much less affected by what's been going on with battery stuff. And then the things that are coming on stream, yes, they've got two more in the UK coming on stream. So Ferringer and Endby this year. But then down the line, they've got a big plant coming in Ireland, then a really big one in California, which, and again, is another good market for storage, and another one in Texas. And they're just biggest volatility swings within energy prices in the US states. They need to build more interconnectors and try and sort it out, and they haven't done it yet, and they won't happen for a while. So those big revenue opportunities are going to be there for quite a long time yet, way beyond where we are now. And obviously the thing in the UK is hopefully temporary, and it will come back again, as we discussed last week. We'll have to wait and see. So I still think this looks okay, and I do think it probably is oversold, but it's quite hard to read where investors are with these things and how pessimistic they are, and whether the message will get through or not. But if you want to sort of tuck something away and sit in it, I do think this might be not a bad option. Now, I bought some Digital 9 on the back of what we talked about last week, and then I've been immensely disappointed. And actually, I've topped it up again this morning. It is a punt. I'm not disputing that at all. So the deal to sell the prime asset, Verne Global, was supposed to go through by the end of March. They always said, because everybody always says that it's subject to regulatory approvals, and as a bit of a surprise, the Icelandic antitrust authority have said they want to look more closely at this deal. I'm not sure the logic behind that, but there we go. But it's going to take them a while to do it. So it means that instead of being end of March for completion, it's going to be somewhere between the 8th of May and the 12th of June. Now, if there was no debt problem, what's the difference? An extra sort of month or two would be really bothered. I think the question, and maybe why people are panicking, is does this have implications for the revolving credit facility? So that renews, I think, on a 3-month basis, and I think it's got to renew around the end of March. So will that be some kind of penalty? Will the actual lenders throw a strop and say, no, you've got to do something radical here? That's an issue, but a manageable one, I think, because as soon as the Verne Global sale goes through, they've got 300 million of cash that's going to pay down the revolving credit facility from 375 down to 75, and then when the other sales kick in later in the year, all of that will disappear. I suppose the bigger risk is what happens if the deal gets blocked, and they have to go back to the drawing board again, and that resets everything. But at the back of my head, I just keep thinking, even if this thing was declared to be insolvent, because it hasn't got the cash immediately to pay its debts, I don't think, if you did sort of fire sell the assets, that I think you'd still end up with a lot more than 14.5p. That's my thinking. And anyway, I've bought a few shares, and we'll see what happens. So that's enough from me.